You've seen it on the 1-minute gold chart dozens of times. Price breaks past a recent swing high, you buy in, and seconds later the market reverses and hits your stop loss. The technical setup was correct, but the move failed because it was a trap designed to mimic a real breakout. This diagram illustrates the difference between momentum and a true reversal. On the left, a break of structure confirms the trend is continuing, but on the right, the pattern breaks its most recent low, a market structure shift showing the opposing side taking control. Retail traders often confuse these two movements. Without a system to filter the price action, these naked breaks leave you vulnerable to sudden changes in market direction. To trade with the larger trend, you have to adopt a subtractive logic model. You must strip away the chaotic chart noise until the actual footprints of the market's biggest participants are visible. Protecting your capital requires knowing which trades to ignore. By applying 3 specific filters, you can distinguish the reliable signals from the noise. The first critical filter is the liquidity sweep. Large financial institutions operate with such massive size that they require high volumes of opposing orders to fill their own positions. They find this volume in predictable pools, retail stop losses gathered right below obvious swing lows. This diagram shows the mechanics of a sweep. The red dots are those retail stops. A price spike pierces the level, triggering the stops and converting them into sell orders. Those orders provide the fuel institutions need to drive the price higher. This creates a mandatory rule for any valid shift. If there is no prior liquidity sweep, there is no trade. By requiring price to run stops before considering an entry, you filter out many of the false moves designed to trap retail traders. The second critical filter is institutional displacement. While retail-driven price action is often slow and choppy, institutional moves are characterized by sudden, energetic momentum. You are looking for large-bodied candles that push past the previous high with very small wicks, indicating strong conviction. This is a fair value gap, a 3-candle sequence where the middle candle moves so fast, the first and third wicks don't overlap. This gap represents an imbalance, indicating a bank entered with volume the opposing side couldn't match. We see this scale on the CME Group trading floor. Gold is one of the most liquid and volatile assets in the world. Relying on anything less than true displacement in these markets makes it difficult to distinguish real moves from high-frequency noise. By filtering for displacement, the chart clearly distinguishes between directionless retail trading and high-volume institutional activity. The third filter is fractal alignment. Even a perfect 1-minute shift is unreliable if it occurs in the middle of a random price range. Lower timeframe setups are only valid when they align with higher timeframe context, such as a 1-hour or 4-hour discount zone. Once confirmed, look for the entry. Don't chase the spike. Wait for price to return to the imbalance. Set a limit order at the gap's top with a stop loss below the sweep low. Aligning timeframe context with the FVG entry creates a specific setup with a clearly defined entry and exit. Mastering the market structure shift is about tracking the movement of high-volume participants. Combining the liquidity sweep, displacement, and fractal alignment moves you away from reactive trading toward a model based on clear confirmation. Executing this strategy requires tools that can handle high volatility. You need a platform with execution speeds that won't compromise your entry or exit points. Download our ICT displacement checklist to audit your setups, open a demo account on the FXNX platform, and test this strategy with 0.0 pick spreads.